Hello everyone and welcome to this session. Today we are going to discuss a very important concept in stock market investing, the difference between P/E ratio and P/B ratio. Both of these ratios are widely used by investors to evaluate whether a stock is undervalued or overvalued, but they measure value in different ways. Let's start with the P/E ratio, or the price-to-earnings ratio. It is calculated as P/E ratio = price per share, earnings per share, EPS. This ratio tells us how much investors are willing to pay for every unit of a company's earnings. A higher P/E generally indicates that investors expect higher future growth. A lower P/E might mean the stock is undervalued or that the company's growth prospects are weak. Example, if a company's share price is Rs 500 and its earnings per share is Rs 50, then the P/E ratio is 10. This means investors are paying 10 times the company's earnings to own the stock. Now let's move to the P/B ratio, or the price-to-book ratio. It is calculated as P/B ratio = price per share, book value per share book. Value is essentially the company's net assets, that is, assets minus liabilities. The P/B ratio compares the market value of a stock to its actual accounting value. A P/B less than the 1st of May suggests the stock is undervalued compared to its assets, while a P/B greater than 1 shows investors are willing to pay more than the book value, often because of growth potential or intangible assets. Example, if a company's share price is Rs 500 and its book value per share is Rs 250, the P/B ratio is 2. This means the stock is trading at twice its book value. Let's compare P/E ratio versus P/B ratio, basis of calculation. P/E ratio uses earnings. P/B ratio uses book value, assets minus liabilities. Best use P/E is more useful for companies with stable earnings. P/B is useful for companies with significant tangible assets like banks and manufacturing firms. Limitations: P/E may not be reliable if earnings are negative or highly volatile. P/B may undervalue companies with strong intangible assets, such as technology or brand value. Investor view high. P/E. Market expects strong growth. Low P/E could be undervalued or risky. Low P/B, stock might be undervalued. High P/B, market expects strong asset utilization or future potential. For example, in the banking sector, investors often rely more on the P/B ratio because banks' assets and liabilities are clearly defined. But for technology companies, the P/E ratio is often more meaningful because earnings growth drives value, and intangible assets like software or patents don't appear in book value. So, to sum up, the P/E ratio tells you how expensive a stock is relative to its earnings. The P/B ratio tells you how expensive a stock is relative to its net assets. Both ratios have their strengths and weaknesses, and smart investors often use them together, along with other financial indicators, before making decisions. Thank you for watching, and I hope this helps you better understand the difference between P/E and P/B ratios.